welcome to the Possible Promise podcast. Every Monday, Wednesday, and Friday, we go live at 12 p.m. Eastern to break down the complexities of finance and point the way to financial success. Today is June 24th, 2020, and I am your host, Brandon Oliveris.
And I'm his wife, Christine.
This is episode 6, The Cyclicality of the Market. Everyone, thanks for joining the podcast. Today is our first Wednesday episode, so I'm pretty excited about that. And so again, if you are listening to the recording and you'd like to tune in live for one of the podcasts, you can go to possiblepromise.com/live, L-I-V-E, and you can listen to it there. And we also have it on YouTube because apparently, I don't know how people have found us on YouTube. I haven't even advertised it yet. But people have found us on YouTube and commented. Well,
you put it on YouTube.
Yes, but I'm saying, like, I haven't advertised our channel.
Ah.
So that's pretty cool. But it's on YouTube. I also have the link on Twitter and Facebook. By the way, I'm trying to make this more public. We have a new Twitter account that I've been using more often. I kind of comment on the market and what's going on that day and such. So if you want to follow us on Twitter, it's at Possible Promise. I was lucky enough to get the actual
very original
the actual name for the username. No, but I hate when like on Facebook I couldn't get Possible Promise as the username for the page because it was already taken by some random person. So figuring that one out. But on Twitter we're Possible Promise, so that's cool. And also, as I mentioned last time, we're now on iTunes and Spotify. Still haven't checked into Stitcher yet, sorry.
He's forgetful, it's okay.
Google Podcasts, whole ton of other stuff that we're on. So pretty much everywhere, except for Stitcher. So check us out there, subscribe, leave a review, and that would be awesome. So today is a really bad day.
Uh-oh.
Okay, so here's the thing. Let's not talk about the market today. Let's talk about kittens. Kittens are cool. Okay, we're not going to talk about the market today because... Just because. No.
If you want to know a little secret, Brandon is a cat person more than a dog person.
Yeah, I love cats. That is true. We don't have one either. I'm going through withdrawal.
Hey, I never said we couldn't.
I know.
Everyone is my witness.
So, alright, here's the thing.
This is the first time I'm hearing about this, so.
Yeah, well, I'm going to tell you about how Brandon was absolutely totally not stupid. Just after I tell you about where everything is. And okay, so...
Don't worry, that means he was stupid.
The S&P is down to only 3,035. Yeah, you're hearing that right. Christina's down 95 handles. 95!
Holy crap.
3%. Okay, this is the kind of day we're having. The Dow, is down like 800 points.
834 points.
Yes, I know. Also 3%.
3.19.
I knew you were going to say that. The NASDAQ is actually below 10,000 for once in its life. Down 254 points. 2.5%. And the good old VIX is up to 36.82, Christine. Up almost 5.5 points, 17%. You're not going to say 0.38?
No, because because it's not over 50. It's still 17. Okay. If you round it.
No, but like 0.38. I'm saying. Yeah. You were so picky about the decimals for all the other ones.
Because I was joking.
So, I should be happy. I've been waiting for a downturn. I should be really happy today. But
ode to the stupidity
I did a
of
thing.
Brandon.
I did a thing. Okay? I did a thing, and it was not a stupid thing.
Uh-huh.
It would have been stupid had I had advanced warning, Oh, my chat says it feels lonely in here, and I'm depressed. Okay. Anyways, I'm not checking that anymore.
You better not be depressed. I'm sitting right here.
I know. Just the chat thing says feels lonely.
I know.
In here.
I heard it. But...
Anyway, okay. So I did a thing yesterday. I thought I'd be smart. Shut up. And so I sold some options on SPX on the S&P index. The one really worked out. I sold what's called a call credit spread. Basically, sell a call and buy a higher call at 3,210, which we're way away from, so that worked. So yesterday afternoon, the market was hanging around 3150. And I thought, I will sell really, really, really far out of the money options. Out of the money just means like really far out where it'll be worthless if the market doesn't go in that direction. But really far out where the chance of getting there is really super low. Like, it was only a 10% chance of actually being worth anything at expiration on both ends. So I sold the 3210 and bought the 3215 calls. That worked out. Then I thought, oh, hey, I'll do it on both ends. I'll do the puts too. I'll sell a put, buy a put. I did it at, again, remember we were at 3150 yesterday. I thought, oh, well, let's see, 3085. No, I'll do 3080. I sold the 3080 put. I bought the 3075 put. And, not going so great.
What is it at again?
It's at
way below
3,035.
Well,
hang on. Let's see. That's 15 minutes old. Let's see. It was down to like 3,020 something. Let's just see where it is right now, because that's 15 minutes delayed. And for some reason, Google gives me the up-to-date, even though my own API doesn't. Okay, we're coming back. We're coming back. 3,044. Only down 2.78%. There's a remote chance that I'll turn out okay today. Not really. No, there is. I've seen crazier things happen. So we're down to 3,044. And I'm extremely sad. So, and the good news is I had a lot of positions close out at a profit today. I mean, I had a Russell 2000 options spread. Two of them actually close out at 50% profit this morning. So everything is going great on those ends, except I was stupid and sold. I mean, of all the days, like, the Monday and Tuesday went great. I mean, it was going, the market was going up. It seemed like it was going to go up forever. And here's the thing. What's the reason it's going down? Okay, well, there are more coronavirus cases in Texas and Florida, and, Texas is at like 97% capacity in their hospitals. But we knew all this yesterday. Pretty much all of this. And yesterday no one cared. And today it's the same exact news, and now suddenly we care. And I don't get it. Just, I don't know. Anyway, I'm bitter. But here's the thing I actually do want to, in all seriousness, that was a gamble, it was just sort of like, let's see what happens. I think it'll turn out okay. And, when you do something like that, you have to be willing to deal with the consequences. So, the consequences were that I could lose money on this, right? Not a horrific amount or anything, but more than I want to lose. But I really thought it wasn't going to happen. But the risk is always, this could happen. You could lose, however much money. And with trading, it's really hard. You have to try not to be emotional.
That's why we laugh at it.
Yeah, you have to kind of say, okay, well, it's done. I'm going to lose all of it. And if you don't, then great. But you have to sort of be willing to lose all of it if it comes to that. Never put on a trade where you're unwilling to deal with the loss if it comes to that. Okay? And no matter how remote it seems, like literally the options I put on, there was a 90% chance of everything going great. 90% chance.
That's so crazy.
And it just happened to be that 10% type of day where, and it's not the end of the day yet. I mean, it could theoretically jump back up I'm 35 points down. If it jumps up 35 points, I'll be okay. But I'm not going to touch it. There's nothing I can do. I just have to kind of see where the market goes.
Yeah.
If it was farther out, this was like a really immediate, close to expiration sort of option trade. If I was farther out, like most of my option trades are maybe 40 to 60 days out, I could adjust it. I could do a lot more. I could roll it out. I could, whatever. But you can't do that when it's so close. And it was a gambit, and I lost, or probably will lose, and that's what happens. But you have to be willing to take that loss and laugh about it and just sort of say like, okay, that's done.
You do get emotional though.
I do get very emotional, yeah, and I really try not to. I think that's everyone. I try not to, but I do, and everyone's like that. But you really have to try not to. And what helps for me is eventually just admitting defeat and saying, okay, that's done, and kind of laughing at how horrifically it's going.
It's fun to tell everybody.
Like earlier, I was like, oh my god, it's going down. Like I was watching this morning, was at 30.95. Well, no, it opened up at 31.14. The S&P did. And so I'm like, okay, that's pretty good, And then it went down to 30.95 and 30.85. I'm like, oh, that's not good. And then I looked after lunch. This is literally half an hour ago. 30.54. And then went down to about 3,030. And it just, at that point, you just have to kind of be like, yep, it's done, I got a message. I'm pretty sure I might have...
I didn't hear it.
Because my watch vibrated. Because I asked someone if they had any questions, even though we have... Let me see what he said today real quick. That's exactly what we're talking about, so that's cool.
What? Oh.
What?
Nothing.
Okay, that's a text I just caught.
That's what I thought.
Anyway, so that's my little tidbit for today. Let's get into our Ask Possible Promise. Alright, so this question just came in. I was asking, and I do have another one. I will probably do, but someone just asked me to talk about the psychology of a trader or investor. He says the robot mentality. So that's kind of what I was just talking about, but I will talk about a little bit more because someone asked about it. So as I was just saying, I would have postponed my little speech to now if I had known. So as I was saying, you have to really try not to be emotional. And you have to be willing to take the loss. And options, it's just a numbers game. Any kind of stocks are a numbers game, really, but with stocks, it's more 50-50, right? You can try to get everything stacked in your favor as much as possible. All the technical indicators and all the chart patterns and, all the analyst ratings and everything else, all the fundamentals. You can try to get everything stacked in your favor, but sometimes a stock's just going to lose, and it's more or less 50-50. With options, you have a much better chance, today notwithstanding, and so it's just a numbers game. Like I said, you can target 70 to 80% chance of winning, and so over time, as I mentioned last Friday in episode 4, over time, the statistics, the numbers will add up to what they should, So if it's a 70% or more probability of winning, probability of profit, then the more trades you do, the more it'll approach 70%. You could do 5 trades and you could win 4 and lose 1, or you could, lose 3 and win 2. It's just kind of random initially, but let's say you get up to 100 trades, 1,000 trades, you're going to get close to that 70 to 80% probability of profit. So it's just about the numbers kind of playing out and letting the probabilities play out how they will, and you'll get there. You'll make a profit. So the biggest thing with options like that, with an option strategy, is to know that the method works, to know that the probabilities are what they are, and to try to kind of be detached from it, because it could look like it's going to go against you at first. And sometimes it will, sometimes it won't. And even if it does go against you at first, it may turn around later on. I've had that happen. For example, I had two option trades on the Russell 2000, well, technically on the ETF for the Russell IWM. I had two trades on that, and they were bearish trades. And the Russell was climbing for the last, like, at least several days, right? And it seemed like, oh, yeah, this is going to not work out. And then today, with the huge drop, the Russell's down over 3%. My option trades closed out at a profit, right? Mm-hmm. So that's the first thing, is just try not to be emotional about it, and really, trust the probabilities that they're going to work out in your favor, because that's, you can, and we'll talk in the future how to know what the probability is, but most brokerage accounts have, probability of profit or probability of in the money, or things like that tell you how likely an options trade is to be profitable. And usually I go for like 70% or more. Because if you go for 70% or more and then you take 50% profit, it actually goes up to about 80, 85, 90% chance of winning. And so the other part of that is that you want to take 50% profit. So a lot of people kind of want to eke out every last penny they can. And you don't want to do that, because it could be going in your favor up to the last week, up to the last day, and then a huge move happens and it goes against you and you lose everything.
Yes, small gains, right?
Small gains, small and consistent gains. And so what I do, actually I have a script.
Of course you do.
Thank you. That does this now, where when it opens up an option trade for me and it gets filled, it automatically creates the closing trade for 50% profit as a good till canceled order. Now, good till canceled GTC order is when you place a trade, usually it expires like that day if it's not filled. But a good till canceled order does exactly what it says. It's opened until either it's canceled or it gets filled. So if I place a trade that's GTC, good till canceled, then at a 50% profit, then whether it's a day later, a week later, a month later, it doesn't matter, that will close out automatically. So I'll get a random email. Oh yeah, this order was filled. Oh cool, I just made a profit on it. Yeah. So my recommendation is the moment you open up an options trade, open up the closing trade for good till canceled for 50% profit. Okay, and then you really don't have to worry about it. All you really have to do is every day come in and kind of look at where your options are. Whether they're in your favor or not, and what's going on, and it takes very little management. Now, if it is starting to go against you, you can do adjustments, you can roll it out to the next expiration. That's all stuff we'll talk about in the future. But my recommendation for kind of being very emotionless about it is, just trust in the probabilities, and the big thing for me is open up the closing trade right away for a good till canceled order, and you'll be surprised when it just fills one day and it's like, okay, that's cool, so those are my recommendations.
That's awesome.
Yeah. So that will be today's quote. The other question I have, I think I'll do next week, because it's kind of discussing stuff we'll be talking about this Friday, so I don't want to confuse things.
Okay.
So that is our Ask Possible Promise for today. And if you do have a question you want us to answer, go to possiblepromise.com/ask, and you can submit your question there. Sorry, our dog is like making noises for no reason.
I think there's something outside.
Probably. So that is that segment. So now we'll go into our main segment. The cyclicality of the market. So, not too bad on time again. Although every time I say that, then we go an hour. I'm really going to try to not go. There's not that much I can say about this. Last time it was like 22 minutes in.
Well, you were giving parables.
Parables?
I'm just kidding. You were telling stories.
Oh, today?
When Monday.
Oh, yeah.
That's why it took so long.
Oh, stories, yeah. You confused me with parables.
I was joking because, well, they were kind of like parables, but they really happened.
Yeah.
It was a joke. It teaches parables. A lesson.
Yes. So today we're talking about the cyclicality of the market. So this is a post I was trying to write for literally probably 2 months.
I think I remember that.
And it just never worked. I'm a lot better at speaking off the cuff than writing out a real detailed post. I will do it when I have to, if I have to. Yeah, even the dog agrees. I don't know if you can hear him or not, but he's just kind of making noises. Oh, yeah, there are people outside. So I'm a lot better at speaking off the cuff than at writing out a real detailed post. I will if I have to, but I enjoy just talking. I don't even prepare. I just talk.
Yeah. And
it works out. So, and you get to hear my dog. Yeah. So the cyclicality of the market. So there's a chart associated with this. If you are listening live, you'll see it on the live page. If you're listening somewhere else besides on our live page on possiblepromise.com/live, I gave a link to a page dedicated to this chart. So if you go to possiblepromise.com/cycles, I didn't want to make people spell cyclicality, so I named it cycles.
That's good.
You're welcome. So possiblepromise.com/cycles, you can see this chart. Or if you're listening to the recording later on, I'll put this chart in the show notes at possiblepromise.com/6. And so the chart I have is a chart, I'll get to it soon. It's an RSI chart of the SPX, and I'll tell you what that means in just a few minutes. So what I want to talk about is how stocks move. Not just stocks, but the market as a whole. Because there's this... Okay, there's a meme out there, and I swear some people take it seriously. Not really, but I mean, they act like it. Where, and I don't know, I'm blind, I don't know exactly what the meme shows. Someone described it to me once, but I forget. But there's a saying I've seen on Reddit a lot, sometimes on Facebook, stonks always go up. Okay, instead of stocks, they say stonks.
That's awesome.
And so there's this kind of idea from some investors that if you have a really good stock, it's just going to go up and up and up and up and up. And to be fair, sometimes in bull markets or in a rally like we've been having, it can seem like that. Like if you take a look at Apple, I should have gotten their chart up previously, but if you take a look at Apple, I mean, they've just been going up pretty much all the time, right? Or there's some stocks that just keep going up no matter what happens. Now, today is probably an exception. I'm actually curious if Apple's down today. I have to check. Hang on. Obviously, there are exceptions. Nothing always goes up, but it's just like the NASDAQ. Okay, the NASDAQ's been going crazily up lately until today. Let's see. Apple. Yeah, Apple's down today.
Oh, wow.
But only 1.5% compared to the broader market, so still. But anyway, people treat stocks as though they're just going to keep going up. And so you'll have a stock that gets hyped up, and this is a cycle I see all the time. You'll see a stock that gets hyped up, and it usually is a cheap one, usually a penny stock. And people start buying into it. There's all this hype surrounding it. It starts growing in price. It might double, it might triple, it might quadruple. And then at its high, people will still buy into it. Okay? Thinking, oh yeah, it'll just keep going up. And then they're surprised when it doesn't. Okay? So, there's a natural movement to stocks. There's a natural movement to stocks. And a stock, unless there's a lot of stuff going on, unless there's, let's say, a really, really good news, we usually call these binary events like earnings or, some kind of announcement from the company. that's really good news or sometimes really bad news, and the stock might make a huge move and then stay there. But most of the time, stocks, if they make a big move, okay, and you've heard me say this in the past, if they make a big move, like I've seen a stock, let's say up 10, 20% for the day, and I'll say, I'm not going to buy into the stock because it's up 20%. I'll wait until it pulls back. Yeah. Because I'm assuming, and it's almost always true, that it's going to pull back, it's going to come back down, maybe not to where it was, but to some middle point, some midpoint between where it was and its high, right? For example, I have a subscription to the Motley Fool, which I probably won't keep.
I was going to say, you don't really care for that.
I don't use it, no. But anyway, I'm on Stock Advisor. And they made a recommendation last Thursday. And I went to look at it. I read the information about it. I went to look. And it was up like 7%. I think it was up like 7, 8, 9% for the day.
Whoa.
And no news, nothing, no earnings. And in fact, the only news source I could find on my Trade the News subscription said that the stock's rise was due to the Motley Fool recommendation.
That is so cool. I remember that last week you told me.
So I thought, this is all hype. There's nothing that came out about the stock to change its value besides that the Fool recommended it. Okay?
That's kind of ridiculous.
That's it. And all these people buy into it, and then people probably see that it's moving, and so more people buy into it, even outside of their subscriber base.
It seemed like they used to be good.
Why is that?
You used to tell me how good they were.
Yeah, I mean, I don't know. They're mixed.
I know. I mean, when you first started.
I don't know. I mean, I was still, kind of seeing how they were, and
yeah.
They have some positive points, but...
Yeah, I get it.
It's just when they have a recommendation, the stock tends to kind of jump up in price. And in fact, I'm curious now. I'm not going to say what the stock is, but just for my own amusement, I'm going to see. Oops. It would help to type it correctly. Yeah, it's down literally 10% from where it was last Thursday. Okay. And a lot of that, I think, is because there was a downgrade of the stock. I saw from an analyst a day or two ago, and a lot of it I think is just today's, down move in the whole market. But anyway, so I won't buy a stock when it's up, 10% for the day, because I know unless there's something that happened like earnings, and even then depends on how big the move was, unless there's really good news, I know it's probably going to come back down.
Usually, what goes up must come down.
Right. So there's a thing, and the opposite too. If it starts going down, it's probably going to come back up.
Right.
So there's a thing, with stocks. Their move is, I kind of consider it like a pendulum, and that's why I show a pendulum in the imagery for today's podcast. And I loved what the designer did with it because it's like a pendulum that's going from a negative chart to a positive chart.
Oh.
So I think that's really cool. But, it's kind of like a pendulum. A pendulum, the farther it goes in one direction, the faster and more violently it's going to come back to its midpoint and then in the other direction. Right? So it's, a pendulum is a really good example because with stocks, when you have a really big up move, you're probably going to see a down move. It's just how it works. There's profit taking is usually what people say it is, or just the stock can't keep going up forever. There's a point at which people start saying, yeah, I'm not willing to buy it above this point. I'm going to take profits off. I'm going to sell it. Whatever. Keep what I gained from this. And so with stocks, momentum stocks, I've talked about stocks that have increased like double in the last 12 weeks. So momentum can definitely push this a little bit farther than usual, but you're still going to see up days and down days. So there's an indicator that kind of measures this right now, not maybe in like day-to-day moves, but across multiple days, across multiple weeks. Relative strength index. And I don't know if I've mentioned this before on the podcast.
I don't think so.
Okay. So
maybe in brief.
The relative, yeah, I think I did. The relative strength index is basically an indicator that gives you a number between 0 and 100 and rates how strong that stock is. Basically what it does is it takes the last usually 14 days, but you can change the number of days, and takes the number of up moves and how big the up moves were divided by the average down move. So it's basically the average up move divided by the average down move over the last 14 days. That's literally the formula for it. And you can, take the average of that or the smoothing average or the exponential. I mean, there's all sorts of different ways. But that's the essential formula. And so you get this number between 0 and 100. But it's not just like, the higher the better.
Right.
Because the idea is, if you've had a ton of up moves, you're probably going to get a down move.
Well, that's just the nature of it, right?
Exactly. Well, that's what the RSI is measuring. Or if you have a ton of down moves, you're probably going to get an up move.
Right.
Right? And so that is what it's measuring. And so around 50 is the midpoint, obviously. But the higher you get above 50, again, it's this pendulum thing. The higher you get above 50, the kind of, you could say, heavier it gets, where the higher it goes, the more likely it is to come back down.
Okay.
And the same thing on the other side. The lower it goes, the more likely it is to come back up. Right? So 70 is usually the point at which it's called overbought.
Yeah.
So overbought for stock means that people have bought it a lot, not that many people have sold it. And because, when you buy a stock, when a lot of people buy stocks, it goes up in price. Right? Yeah. It's just how it works. Because when you buy it, it's like, okay, well, this is popular. People can sell it at a higher price. It's basic supply and demand. Right. So overbought just means it's been bid up. It's been bought too much. The price has risen too much. And it's probably going to come back down. Oversold, which I'll talk about in a second, is when the stock's just been sold way too much. It's gone down way too much. It's probably going to come back up. So an RSI of about 70 is usually what's considered overbought. And the higher it gets above 70, especially, the more likely there is to be a correction and it comes back down.
Is there something like that for the lower one?
Yep.
Okay.
Yep, so oversold is around 30, so basically plus or minus 20 from the midpoint.
I was just going to say that.
50. So below 30 is oversold, and the lower below 30 it gets, the more likely it is to turn around. Now, on that chart, okay, so I apologize for how I did this chart. I wanted to show the comparison of the S&P 500's price over the last month versus its RSI. So on the left, you see an axis on the left, which is the price, and an axis on the right, which is the RSI. I didn't want to do two separate charts because I thought that'd be confusing, so I did kind of two axes in one chart. And so the blue line you say candlesticks, they're the, candles of the S&P, and then the red line on the chart is the RSI. And you see for the S&P, I think I started it around May 26th. It kind of steadily rises in both price and RSI. RSI starts around 60 or so, peaks around June 8th, where the S&P is over 3,200, and the RSI is about 74.
Oh, wow.
So overbought. And then dips, and the RSI, we had this huge pullback over the next 3 days. On June 11th, the RSI is at 48.
Oh, wow.
And the chart, I think it's right around, or the price is around 3,000, I think it was. And so we had this huge pullback. RSI got over 70, it got up to 74. And then you have this massive pullback down to 48. So it's a perfect example of what I'm talking about. And then ever since then, it's been kind of climbing up through the 50s. Today puts it back down around 51 or so. depending where we end up at the end of the day. Now, the thing is, with the S&P, because there are a lot of risks right now, traders haven't really let it get up too high in the RSI. So the last time we saw an RSI of over 70 was all the way back in January.
Oh, wow.
Right. Not even February. So just because the price is going up overall doesn't mean all the time the RSI is going to go up. Because if the price kind of goes up gradually, the RSI will stay pretty steady.
Wait, but you said it was at 74
in
June?
In June, yes.
So that's not true what you said about January then, right? That since January?
No, the last time before June.
Oh, okay.
That it was over 70 was in January.
Oh, sorry.
So for 5 months, it was below 70.
I'm sorry.
That's okay. So, it's when a price is going up gradually, the RSI will stay pretty steady. 50s, 60s, whatever. Above 50 is usually considered bullish. Below 50 is bearish. And so it's just when you have those big moves that the RSI really jumps. And you can see that from June 8th to the 11th, when the price fell like 200, 250 points, and the RSI fell about 25 points, from 74 down to about 48. And so that's the kind of, it really shows the cyclicality of it, because it was climbing, almost directly up. There were a couple days where it was down, but almost directly up. And then once it reached 74, it was like, oh, no, we can't be up this high. Now we have to kind of sell. Right? And that's not literally what people are thinking, obviously. People aren't looking at the RSI and saying, oh, well, it's up too high, we have to sell. No.
Though I would be probably thinking.
It's just kind of how it works.
Right.
Okay? And so you can see the cyclicality of it went back down to under 50, and now we've been climbing back up through the 50s, almost got to 60, but now, because of today's pullback, we're back down. And again, who knows what we'll be at the end of the day.
It's just so interesting how easy it is just to watch the numbers and be like, okay, because it's going up so much, I should hold off.
Yeah, or, maybe not commit too much, because, like
right.
I said on Monday, one of Monday's picks, if you remember, I said had an RSI of 70, but because it had a lot of momentum, I was kind of comfortable with that and said, it's, with momentum, it can stay over 70 for a while. With high momentum stocks, it can even get up into like 80 or so before it starts to get weak. So it's not an exact science. And I know people who say that RSI is not accurate. There are people who say no technical indicators are accurate. I disagree. And you can see a very good example of that with the chart I provided. It's not an exact science. A stock can stay over 70 for a while. It's just kind of a good indicator that, there's probably more room to the downside than to the upside.
Right.
Just probably. Right? And so that's how it works. But
a lot of it is intuitive, too, I feel like.
Yeah, I mean, you can kind of feel like, it feels like things are pretty high, and it's been going up for days now. Like, for example, the NASDAQ. The NASDAQ was up 8 days in a row. And that's just, when you have 8 up days in a row, you're going to have a down day. It just has to happen. In fact, I'll tell you what the RSI was for the NASDAQ. Just a second. Let's see. Not for today, because today's an exception. For yesterday, it was up to 68, which actually I'm surprised is not higher. So, but it was, getting into the 60s. But then today, let's see, today is back down to 59. So the NASDAQ was just going up, 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 up. And you have to have a turnaround. You have to have, that's enough. You know what I mean? So it's just how stocks work. They don't always go up. They don't always go down. You kind of have this cyclicality where it moves up a certain extent, and then it gets pulled back down a certain extent, and then it gets pulled back up a certain extent. That's just kind of how it works, especially between earnings cycles. You have earnings, and that could move the stock either positively or negatively when they have earnings. But even with earnings, you'll see sometimes where it might go up 10-20% and then get sold off because it's like, oh no, that's too much, right? Sometimes that won't happen, but this is just kind of, it's not a science. It's right. I don't want to say it's an art, but it
kind of is
too cliche. But yeah, so stocks move in cycles. Now I mentioned a while ago, like I don't remember second episode. Oops, sorry,
that was you.
I mentioned about volatility. Now, volatility is sort of a measure of how much you can expect a stock to move.
Right. And sometimes it moves all the time.
Right.
Up and down.
Right, exactly. But like how big those moves are expected to be.
Yeah.
So, and I gave an equation. If you remember, it's the equation, and I'll give it again in the show notes, is just the implied volatility of that stock multiplied by the square root of however many days you're looking at over 365. So if you're looking at a 1 day move, then it's the volatility times the square root of 1 over 365. If you're looking at like a month, then you might do 30 over 365. It just depends. But that's how you get your expected move. So, now that's like an expected move for a stock is, do you know what standard deviation means?
Oh gosh, a long time ago.
Okay, so a standard deviation is just like, there's a 68% chance, that's one standard deviation, that the stock will move in this range. Okay?
Yeah, did I learn about that in math?
Sure, it's more statistics.
Yeah, we had to do a little bit of that, and I was so bad at it.
So this gives you the one standard deviation move, and all this means is like, this kind of shows you, in this amount of time, it probably shouldn't move above this amount or below that amount. So, for example, if we take the S&P, okay, now I have a little script that does this for me, so that's pretty cool.
Of course you do.
Yep. Let's see, SPX. So, the 1 day expected move today, now volatility is up today, so it's going to be a little, oops, I got that wrong. Oh, you know what it is? I used the wrong keyword. This is going to be a little higher today. Yesterday, the expected move was about 1.5%. Today, the expected move... Actually, not too much different.
Not much.
So 1.56%. So the SPX, the S&P 500, the daily expected move is about 1.5%. And that's with, high volatility. And that's about a $47 plus or minus. Okay, so it could go up $47, it could go down $47. That's sort of the expected move. And then, you just add or subtract that from the current price. So, in 1 day, now, obviously today is outside that expected range, because it was just, that can happen. It's only a 68% chance. But that's what I mean about cycles. So a lot of times what you'll see is where a stock might go down a bit for the day, and then might go up a bit for the day, and then, or it'll go up and down in a range.
Yeah.
And the expected move kind of tells you, this is the range that it's probably going to go in. So for the SPX, let's just say you go out until even, I'm trying to think, September. Let's just take like 3 months, right? So I can do this too. So you can calculate in what kind of range will the S&P 500 probably trade in over the next 3 months.
That's crazy.
Okay. And so the expected range percent is about plus or minus 14%. So this is September 18th, because the third Friday of the month. By the middle of September, we could be up 14%, we could be down 14%, or anywhere in the middle of that. Okay?
Huh.
That's the expected move. We probably won't go outside of that range in the next 3 months. Okay?
Huh.
The dollar range is about $426. So let's just say about $2,600 to about $3,400. Like, that's that's about the expected range between now and September. Now, it'll probably go on both ends. It might go down a couple hundred, it might go up a couple hundred. But it probably won't go outside that range. And the farther outside that range it may go, the more likely it is to come back down into the range. Okay, does that make sense?
Yes.
So, wow, really?
I think so.
Good. So because of the pendulum thing, if I pull out that pendulum more than, $400, it's going to, and even up to that limit, it's going to want to come back down towards the middle.
It just makes sense.
Yeah. And so you can do that for any time range. You can even do it for a whole year,
How about 20 years? No, just kidding.
Well, I mean, you could. I don't know how accurate it would be.
No.
But, you can even do that for a whole year. And so that's just sort of how it works.
Even that might not be too accurate.
Yeah, well, that's, yeah.
I mean, it could be, but...
Right, so that expected move, it shows you kind of the arc of that pendulum, like how far in either direction it could move. It could go outside that arc, but it's not likely. And if it does, it'll probably get pulled back into or towards the center. So that's just sort of how it works. Now, it's not a guarantee. There are no guarantees, just like today shows. I mean, today's a down move of 3%, twice the one standard deviation.
Mm-hmm.
But it's just sort of a good rule of thumb. It's just what will probably happen, right? And so that can be done for any stock. In fact, I'll give you the same thing for Apple. So the one-day move of Apple... Let me type it out. The one-day move for Apple is about 2.06%. So it's a little more volatile than S&P.
That's interesting.
Right. And
especially because it's tech.
Yeah, I know. So then the dollar move is about $7.40. And that's just for one day. Now, if we do the same thing with Apple, where we say, okay, how much by, September? That's going to be about 15.8%. Okay, so that's for Apple. The dollar move, now Apple today is at, what price? It's about $3.61. So the dollar move is plus or minus $57.
Wow.
So you could be at anywhere between, $304 to $418 by September. Now, how is that useful? Actually, I love this. I didn't plan this, but this is going to go perfectly into Friday's topic.
This is awesome.
And so the reason this is useful, now, if you are trying to pick a direction, you don't know where in that range it's going to go. It could go up, it could go down, it'll probably do a bit of both. But if you're an options seller, and I talked about this last Friday, I'm going to talk about more this Friday, then you can sort of say, oh, it can go up 14% by September. Okay, well, I will sell an option above 14% of that range. And as long as it stays within that range, I'll profit. Okay, so you can sell an option spread. We'll talk about spreads on Friday. You can sell a credit spread, it's called, where you get money for selling it, that says, yeah, as long as it stays within its expected range, or whatever range I define, I will win. It's non-directional. You don't care what direction it goes in, as long as it kind of stays within that range, which it's 70% likely to do. Do you see the power of that? So I don't know where Apple's going to go by September, if it's going to be up to $400 or down to $300. I just know there's a 68% chance that it'll be between those two prices, or whatever I said, 304 to 418.
Yeah.
I don't know if the S&P 500 will be down at 2,600 or up at 3,400 by September, or somewhere in the middle. I just know it's 68% likely to stay in that range, to kind of, like a pendulum, to swing back and forth. We had an upswing for the last several days, and now we're having a downswing. It's just the pendulum at work, right? Why is today so violent? Probably because we had such a rally over the last week. We just had one up day after another. And so that's that pendulum at work. The stronger the rally, the more violent the pullback. That's just kind of how it happens. So I don't know by September. I'm just picking September out of thin air just because.
It's because it's your birthday month.
That is very true. It's 3 months away. I don't know where the S&P 500 will be, whether it will go up or whether it will go down. I can tell you I bet it'll go down, but I'm not willing to put that much money on it. But I can tell you that there's a 68% chance that it'll be above 2,600 and below 3,400. And, that if it does go outside that range, it'll probably get pulled back within the range. And so I can make a trade, an options trade, that profits if it stays in that range. Mm-hmm. Like that's the power of options, as I've been, going on about. Do you see what I mean? So you can take advantage of the pendulum-like nature of the market, of stocks, by outlining its outer edges of the expected move it could go in, and if it stays within that range, then you profit, which it will almost 70% of the time.
Which you'll teach us on Friday.
Exactly. So hopefully that makes sense. I think looking at that chart, you can really see how you have the up move, a huge correction, relatively speaking, for the RSI, went down 24 points, and then kind of been climbing back up and then going back down. It's just, that's how it works. It's a pendulum, right? Yeah. So even in the sell-off in March, I think the lowest RSI we saw was about a 29, I think. I was looking at it a couple weeks ago when I was planning out this post. So the lowest RSI we saw, even though the market fell 1,000 points, was about a 29, which was oversold, and then the market came back up. You see what I mean? So it's really powerful. I love the RSI, and there are lots of places out there where you can get the RSI for a certain stock, but it's really useful. But that's just what you need to know about the moves of a stock. And again, if a stock is really rocketing upwards, don't jump on that train. I mean, you're probably going to be disappointed, right? Especially if it's a couple day move where it's going way up. Don't jump on that. Right? It's just, it's probably going to come back. It's probably going to sell off a bit. Wait till it sells off, then jump on if you want to. But these people who wait till a stock like quadruples in price and then they jump on, it's like, why would you do that?
Yeah.
This is why I want to talk about the cyclicality of the market, because once you know that, then you can use it to your advantage. You don't have to worry about if the stock is going up or down or whichever direction. You can say, yeah, I'm 70% sure it's going to stay in this range, and so I'm going to profit by that. And we'll talk about that Friday.
Yep.
Cool. So hopefully that makes sense. I'm really glad that
for saying you didn't have much to say.
Hey, you be quiet. So when I get into numbers, I get into numbers.
Yes, you do.
But
that's good, though.
Yeah. So I hope you enjoy this. If you have questions, let me know. You can see the show notes at possiblepromise.com/6. And with that, we will see you on Friday for the next episode of the Possible Promise podcast. Thanks, everyone, and have a great rest of your week.
Bye, and I will see you Friday.
Bye, everyone.
Bye.